1. Start with energy, explain with authority, highlight with emphasis, and with warmth. The markets are currently paused for the remainder of the holiday weekend, and Nuburu Inc., ticker symbol BURU, is frozen on the charts at exactly 0.24 USD. During the last active trading session on November 28th, we witnessed a sudden and aggressive spike, with the stock jumping 0.022 USD to lock in a daily gain of 9.85%. In the after-hours electronic markets, the momentum continued with a slight drift upward to 0.25 USD. If you are a retail trader scrolling through your Robinhood app or checking your SoFi Invest dashboard, a nearly 10% gain on a penny stock trading under a quarter looks like the start of a massive breakout. The expectation building on social media forums, fueled by the recent flurry of press releases in November 2025, is that Nuburu is a sleeping giant in the defense sector. The narrative is that their unique blue laser technology is finally finding a home in the military-industrial complex through new partnerships in Italy, and that the stock is destined to climb back to dollarland and beyond. The reality, however, is that you are looking at a company undergoing a radical and desperate identity transplant. Nuburu is effectively trying to morph from an industrial laser manufacturer into a defense contractor in real time, all while navigating a financial minefield that would terrify a conservative risk manager at Fidelity Wealth Management. The 0.24 USD price tag isn't just a discount, it is a reflection of extreme dilution risk and a balance sheet that is being held together by some of the most complex financial engineering in the microcap space. To understand why this stock is a high-voltage warning sign rather than a simple buy, we have to look past the press releases and into the filings that most investors ignore. Let's start with the catalyst that likely drove this recent 9.85% spike. In mid-November 2025, Nuburu announced the execution of the first tranche of financial support for its Italian partner, Tecni SpA. The headline sounds fantastic. Nuburu executes financial program. It sounds like they are flush with cash and acting as a banker for their partners. But dig deeper into the mechanics of this deal. This funding is being facilitated through an inventory monetization platform powered by Supply at Me Capital. This is not a standard bank loan or a simple equity investment from cash on hand. It is a complex financing tool where inventory is essentially used as currency. For a company like Nuburu, which has faced severe liquidity crunches throughout 2024 and 2025, using such exotic financial instruments signals creativity, yes, but also necessity. They are finding money wherever they can to keep these deals alive. The expectation is that this Tecni deal and the acquisition of Orbit Searle SRL, an Italian software firm, will immediately generate revenue. The reality is that these are intricate cross-border transactions involving related parties and regulatory hurdles. The Golden Power Review by the Italian government, a regulatory check on foreign investment in strategic assets, is a massive variable. While Nuburu has committed to submitting a comprehensive notification to the Italian government by the end of 2025, there is no guarantee of approval. If Rome says no, the entire defense pivot strategy hits a brick wall. If you are holding shares in your Interactive Brokers account, you need to be painfully aware of the authorized share situation. Back in mid-2025, shareholders approved an increase in authorized shares from 250 million to 900 million. Read that again, 900 million. With the stock trading at 24 cents, the market cap is tiny. This massive authorized share count is like a loaded gun pointed at the equity structure. It gives management the ability to issue hundreds of millions of new shares to pay for these acquisitions, to pay off debt, or simply to fund operations. This is the dilution overhang that keeps the price suppressed. Every time the stock pops 10% on news, like it just did, it creates an opportunity for the company or its financiers holding convertible notes to sell into the volume. Let's talk about the blue laser narrative because it is undeniably cool and serves as the technological foundation for the entire bull thesis. Nuburu's core technology is high-brightness blue lasers. Unlike standard infrared lasers used by almost everyone else, blue lasers are absorbed much better by reflective metals like copper, gold, and aluminum. This makes them perfect for welding EV batteries and 3D printing aerospace parts. The physics are sound, but the business of selling these lasers has been brutal. Industrial adoption has been slower and more capital-intensive than expected. This forced the company to pivot. The pivot is aggressive. Move away from just selling the engine, the laser, and start selling the car, the defense solution. This brings us to the dual CEO structure established in October 2025. Nuburu appointed Alessandro Zamboni and Dario Barassoni as co-CEOs. Co-CEO structures are rare and often messy. They can lead to slow decision-making or power struggles. However, in this case, it seems designed to bridge the gap between the U.S. operations and the new Italian targets. Alessandro Zamboni is the fintech architect. He's the link to supply at Me Capital and the complex financing structures. Dario Barassoni is the defense operator. If this structure works, it could be the bridge that turns Nuburu into a transatlantic defense player. If it fails, it adds chaos to an already complex situation. The fact that the stock is lingering at 24 cents suggests the market is skeptical of this two-headed leadership model. For those using Fidelity mobile app or Webull to track technicals, the 20-cent level is the critical support. We are currently bouncing off that bottom. The 9.85% move on high volume suggests that a bottom fishing algorithm or a newsletter alert might have triggered a buy wave. However, the resistance at 30 cents and 35 cents is thick. There are thousands of shareholders who bought in the 50-cent range earlier this year or even higher before the 2024 reverse split. This overhead supply acts like a ceiling. For the stock to truly break out, it needs a catalyst that is bigger than a partnership announcement. It needs a funded purchase order with a dollar figure attached that hits the bank account, not just a framework agreement. We must also discuss the reverse split trauma. If you have been following this stock for more than a year, you remember the 1-for-40 reverse stock split in July 2024. If you owned 4,000 shares before that day, you woke up owning 100. Reverse splits are rarely a sign of strength. They are a survival maneuver to stay listed on the exchange. The stock has drifted lower since then, a phenomenon known as post-split depression. The market often shorts these names because they know the company is desperate to keep the price above the $1 compliance threshold. The current price of 24 cents puts them right back in the danger zone. They are once again non-compliant with the NYSE American low price rules. This starts the clock ticking on a potential delisting or, you guessed it, another reverse split in 2026 if they can't get the price up organically. I want to pause here and ask you, have you ever held a stock through a reverse split? Did you average down or cut your losses? Comment below with your experience. Now, let's look at the NASA connection. Nuburu has won contracts with NASA to demonstrate power beaming technology on the moon. This is the sci-fi angle that gets retail investors excited. Using blue lasers to transmit power wirelessly over kilometers is revolutionary. If this technology is adopted for the Artemis missions, the PR value alone is worth millions. But again, apply the reality filter. Government R&D grants, like the Phase 2 SBIR award they received, are small compared to the cash needed to run a public company. An $850,000 grant keeps the R&D team employed for a few months. It does not solve the liquidity crisis. It is prestige, not profit. At least for now. Let's look at the institutional picture. Institutional ownership is low. You don't see massive buy-ins from Fidelity mutual funds or Vanguard here. This is a retail-heavy stock. This means the price action is driven by sentiment, rumors, and momentum, rather than fundamental valuation models. It makes the stock incredibly volatile. A single negative post on a popular forum can send it down 10%. A single positive rumor can send it up 20%. If you are using investing sites to research this, pay attention to the cash burn rate in the upcoming earnings. In recent quarters, they have managed to survive largely through financing, not operations. They are still losing money on the products they sell. The gross margin has been a disaster area in the past. The new management claims they are fixing this by focusing on higher-margin defense software, Orbit, rather than just hardware. If they can show a path to positive gross margins, the stock re-rates instantly. That is the bull case. The acquisition of Orbit Searle SRL is particularly interesting. Orbit is a software company specializing in operational resilience. This is a high-margin business. By acquiring them, Nuburu is trying to mix hardware valuations, which are low, with SaaS